everybody. My name's Towelie, and I have an investment idea for you.
Hey, Towelie, what are you doing?
Well, I'm just telling these people about what they can invest in that might make their portfolio go much, much higher.
All right, Towelie, stop it. Back on the rack. Get out of here. We'll talk later.
Oh, I never get to have any fun.
All right, sorry about that, folks. That was Towelie, and I have sent him back to the rack. My name's Kirk Spano. This is Investing 2020s, and I think we have something to talk about that will indeed make your portfolio go higher. So this week, we got news from the government that we've been waiting on literally for years. I think 2 to 3 years we've been talking about this, and it finally looks like it's going to happen. Now, institutions can't move on this news like we can because they have to wait for certain things to happen to meet their investment criteria in the way that their funds set out. So what was the big news? The big news was that marijuana and cannabis in general is going to be moved from a category 1 to a category 3 for drugs. And what that means is that marijuana would be regulated very similarly to alcohol across the country. We'd also see most states not being able to prohibit the use of marijuana because it would be a tier 3, which essentially is similar to alcohol. What does this mean for the investor? Well, the marijuana companies would probably still have some problems with access to the financial system, at least for a while. But I think that this step in the categorization of the drug would almost immediately or very shortly thereafter lead to some normalization within the financial industry for cannabis and marijuana stocks. Now, why is this important to really start to look at some of the ideas around how this would work for investing? Well, it's not going to be a winner-take-all sort of thing, except I do think there is one huge winner here, and we'll talk about it in just a minute. But as marijuana becomes more acceptable, not only to use, but also for the companies involved to be involved in the financial system of the country, you see a lot of upside. And there are certain winners and probably some that won't win as much. Now, I don't know that marijuana use will go up terribly much. I really don't. I think anybody who wants to use is pretty much using, and if they feel like they're going to get caught and given a ticket, I don't think they care very much. In those 12 states, right? There's only 12 states left that have no type of legalized marijuana. Most of the states that have legalized marijuana is medicinal, but it's almost half actually for recreational. So you're starting to see at the state level, virtually everyone is already starting to accept it anyway. The recategorization sets the stage for federal rules and regulation that, again, become very similar to alcohol. And this isn't just Democrats, it's everybody. Everybody's starting to realize, look, if we're going to keep alcohol legal, why wouldn't we do the same with marijuana? And I think this is becoming pretty accepted across the board. If you don't think alcohol should be legal, then maybe you don't think marijuana should be legal. However, neither seems to be any more of a gateway drug than the other. I've done a little comparison of the ETFs that are out there, and I think that what we really want to take a look at are the ETFs that focus on the US market. So here are 5 of the most popular ETFs. YOLO used to be much bigger than the 38 million that it has in right now. MSOS, the pure US cannabis ETF, has really absorbed most of that money because they are US focused. Now, they also have Canadian companies through their US listings. They use a lot of derivatives in this portfolio to create the portfolio that corresponds to what they want their index to be. They have to use derivatives because there's not really any other way to do it with direct listings. Interestingly, it's kind of an expensive fund. 80 basis points is what you see for the expense ratio, but trading derivatives is expensive. And that comes off the top of the returns and doesn't get factored into the expense ratio. So the real trading cost plus expense ratio here is up over 3%. So more than 3% coming off the top of your returns. The same is true with MJUS, which has been growing. It was at $7 million a couple of years ago. So it's growing fast. Just want to show you the two funds. Here's MSOS, and you can see they're using swaps to create the portfolio, which is expensive. Over here, MJUS is doing a similar thing, but holding a ton of money in treasuries right now as they create the leverage to have their holdings. And they only have about 24 actual cannabis-based holdings. So not terribly diversified. MSOS is up at 77, really a little bit lower because they too have treasuries. And what you can see is that these numbers add up to way over 100% because they're using leverage. Now, when a market is way down, that leverage can blow up a fund. And we can see that when we take a look at the chart of MSOS. Talk about getting taken to the woodshed from a high near 50 to a low near 5. So a 95% loss. Excuse me, a 90% loss. Over here, you will notice one name, Innovative Industrial Properties. We've talked about this one before. That's in MJUS. MSOS does not really hold much innovative industrial. It's about 2% holding. Why am I pointing that out? It's because I think that probably innovative industrial properties is what you want to own. Here's why. Innovative industrial properties has greenhouses that the marijuana is grown in for many, many companies in the marijuana space. These are triple net leases, and Innovative has got a piece of a lot of these companies as part of the way that they financed the deals for them. So a marijuana company would need a grow facility, and Innovative would finance it for them on a triple net lease with some other kickers. The banking system wasn't able to do that at the time. I think the banking system will be able to do it soon, but again, I'm not so sure the growth is going to be all that high. Again, I think that most people who use already use. There'll be a few more that add, a couple scaredy cats to sit at the campfire and have an edible, or maybe they do the pass, puff, or is it puff, pass? I don't remember. I don't do the puff puffs. Yeah, right. I don't. I like the edibles. So I really like innovative industrial properties because to me, it's a lot like an ETF without the expenses. How so? Well, if they have a piece of all these companies, then it's kind of like they're diversified across 10, 12, 15 companies. I believe they actually do business with 22 cannabis companies. I have to double check that, but it's a pretty good number. Not very different from the diversification that you get in the ETFs. Now, it is exclusively American. And I think that being exclusively American here is a good thing. A, it's a big growth market. B, as these companies are able to monetize through the financial system, that's really good for them. And it means that the rents get paid at IIPR. So if Innovative is collecting rents on triple net leases from companies that are getting healthier and had like a 97 or 98% pay ratio anyway, suddenly Innovative has a much better position. And because they grew first before the banks got involved, they have a really nice portfolio of facilities. And the companies that are involved with may continue to do business with them rather than going to the bank. Now, I don't think that Innovative will get as good of a deal as they did in the past, but the first mover advantage here is huge. There's another company that does a similar thing, but they don't have a very big portfolio yet. That'd be New Lake Capital. So the reason that people jumped into New Lake Capital is they thought, oh, they're going to copy IIPR. Not exactly. As cannabis companies actually get into the financial system, the spreads, the amount they could make on these loans and these financing deals is going to shrink. So what you want is the company that already has a big portfolio where all the rents get paid. Because companies that are already growing with them, they're not going to go out and build new stuff. They already have sunken costs. The expansion will be different. But these deals are pretty good. And would you spend, $20 million to save a couple million? No. Because you look out 10 years and you go, well, with amortization and everything else, might as well keep the deal we have. I don't think you're going to see rent increases very much. But again, this is already in place. So it really just becomes a math equation. Will Innovative grow? Sure. Will New Lake grow? Sure. Will some of these cannabis companies just build their own grow facilities because they can get big financing now or soon? Yeah. So it really just comes down to being a portfolio play. And when you take a look at this, it's so beat up and just coming off its bottom that there's probably a lot of upside to go. I say it'll make a run at new highs in the next few years. Will it jump into new highs on some sort of FOMO? Maybe, but my guess is that it doesn't quite get to new highs. I like this area in here, which I've had circled for a couple years now. This area in here is where I expect it to get back to. So if we clone this, and learn how to use our tools, I'd say something like that would be my price target. There we go. Playing with toys. Looks almost like a happy face. It sure does. So I think that this is probably what we should expect. A double to triple. But wait, there's more. We take a look at IIPR. Not only do we notice that it has very low debt, but for those of you who want a dividend yield, and I've got dividend yield over 8%. And here is the kicker. This is the past year, I believe, past couple years. These are all the ETFs. They all move pretty similarly no matter what their function, what they're trying to do. And here's IIPR. You can stretch it out, take a look at them a little bit differently. IIPR. I think this really comes down to a fundamental problem with the ETFs. So I really do think that IIPR has the diversification that an ETF would have, give or take, and it has the safety of all these triple net leases from companies that are doing well and look like they'll probably do well for a while, if not forever. And it'll take a very, very long time for IIPR to face competition from the banking system over time, especially when it comes to potentially replacing the deals they already have. Now, most of these contracts are 20 and 30 years, so there's really not a lot of risk to IIPR shrinking. I just think their growth will be slower. And remember the back door here. This IIPR, I think, because of their expertise in growing cannabis, and with climate change becoming more and more apparent to more and more people, the idea that they would start getting into growing vegetables and fruits that they can do in a semi-vertical fashion in the greenhouses, I think is very, very likely. I don't know how long that will take, but it is something underneath the marijuana, which looks like a great deal. So if they get new growth in the future, above and beyond the cannabis, probably be growing produce, which I think is going to be a gigantic business in the future. And since we don't stop eating, I think could be very, very profitable. Think about the farmers who grow at one level, right? They grow at the ground level. Now consider using greenhouses where you can stack the growth 5, 6, 10 stories high. I mean, you really can build buildings like that. Or in the shorter term, you probably just see, 14-foot walls, which is pretty standard. And you get maybe 6 trays of vegetables, where otherwise a farmer would have 1. Think about the economies there. So I think that this is a pretty great way to get into the cannabis industry. I think so too. He just won't shut up. Once they get going, they just don't quiet down, and then they start laughing and asking for Cheetos. I think this is probably my favorite one. I like the diversification it gets through the leases and access to all those companies. There's no management fee. They pass through a big dividend. They've outgrown the ETFs. You don't have to worry about derivatives. I think this is absolutely my favorite marijuana stock. Now, there's probably a couple brands out there that are going to take off. And I'm not entirely sure how to figure that question out as to which brand is going to take off. It's very competitive. I think this is a great way to get a play on the industry without having to have a high expense ETF or guessing which brands are going to be the leaders. Because that's all it is a guess. I believe that this will outgrow the S&P 500 somewhere by 5 to 10% annually for at least several years, essentially accounting for the dividend. So if it grows in line with the S&P 500, but then has that big dividend on top, there you go. A pretty easy way to fortify any portfolio. This can go into a growth portfolio because it probably grows more than the S&P 500. And then that dividend funnels into your portfolio, and you can use that money to buy other growth stocks. In a dividend portfolio, this is higher growth than almost anything else you're going to have. And it's a fat dividend at 8%. company has very low debt. It's a lot like gambling. Remember during COVID, the casinos had 100% of the rents paid? It was a big deal when these guys went from 100% to 97.8% because they had like 3 growers have problems. They're going to go back to 100%. So that's what I like here in the marijuana space. I was going to talk about Jerome Powell today. I'll wait until next week for that. But I am writing an article today and tomorrow. Maybe I'll get it done today. And the title is, If Jay Powell Kills Employment, He Kills Everything, or He Kills the Economy. If you listen to, I forget who was on Bloomberg today, but I think it was the Atlanta president. He said he didn't see any more need for raising rates, that they should just sit back and see what the effects are. I think they already know the answer to that. They just don't want the stock market to go through the roof. They're really trying to manage valuations, and I think they've done a pretty good job. I still think there's 100, 200 S&P 500 stocks that just have longer term problems. I think a lot of folks are taking a breath with the mega caps, especially the tech, the Magnificent Seven. And as we know, the small caps are dramatically undervalued. Literally, there's a lot of small caps out there that can triple or quadruple or quintuple in the next few years. They're just that undervalued for what they do and what their revenues are and their debts and their assets. I still think the small cap stocks are the way to play most of the market. And then you augment your portfolio with real estate holdings. That gives you a secured asset that grows over time with an income stream if you do it right. And then the small cap stocks give you growth. And yeah, we'll sprinkle in some mid caps and some other REITs in industry and specialty holdings. This would be a specialty REIT. But there's just so much of the market you need to ignore, mainly individual stocks on the S&P 500 and the S&P 500 index itself. My barbell is mainly small and mid caps on one side, and then real estate and real estate investment trusts on the other side. Almost nothing else in the middle. And the industries that I'm very interested in, again, are involved with decarbonization, which includes oil and gas companies now, right? Because they're the ones doing carbon capture. The fourth industrial revolution, space. I love space. I think we're early, but I think that the prices are so low that we can tolerate it. And then real estate, because there's going to be massive climate change induced migrations. And this is something that the Pentagon has been tracking for 20 years now, 21 years now, in their quadrennial report. Look up quadrennial report and read it. It's online. It'll wake you up when you start reading what the Pentagon thinks is scary. And they think climate change is scary. And then the other thing that I'm interested in is companies that can drive healthcare deflation so that we can afford to take care of ourselves as we get older without bankrupting the world. And remember the background story here. Slow growth forever, and deflation, not inflation, is the real boogeyman. Inflation here is transitory. It'll be gone in a few years as energy gets cheaper and as healthcare stops inflating. It goes from inflation to disinflation to deflation outright.
What does that have to do with marijuanas?
Well, I guess it means a few more campfires because the world's actually going to get easier. We just have to remember to keep educating ourselves so we don't get all fat, dumb, and happy. For some of you who haven't heard that story, I'll give you the quick recap. I went fishing in Michigan, Little Muskegon River, and we were the guests of a friend of mine's grandfather and then his good friend from World War II. They were both in World War II, an American soldier and a British soldier. And the British soldier came over here to work in industry. They became friends again when he got here, and they were our hosts. And over these gigantic porterhouses they bought directly from a butcher, they said, look, some things that you got to remember, and this is 1990. Things get really bad when people get fat, dumb, and happy. They become lazy in the way they think and the way they work. And you have to watch out for that. And I think we've gone through a couple cycles of that. And I think that we still continue to progress despite it. But that is the big thing to worry about. If we don't educate our kids because we let them use AI to do their work, the same way we let them use cell phones to do their work, we let their brains turn to mush on video games that just basically train them how to be angry soldiers, then we're going to have a big problem a generation or two from now. If we focus on education, we focus on even old literature so that people get a perspective of history, versus being sucked into these short-term narratives by people who are just trying to make money. A lot of good things.
And a good time to think about that is when you're a little high.
That may be true, Towelie. That might be true. But I do think that things continue to get better, and a lot of the narratives are wrong. So focus on what really is happening. Standards of living continue to go up. There's fewer boots on the ground in wars right now than ever before, even with Ukraine. And we're facing different challenges than we did in the past. The biggest one being climate change. And then the next one being, how do we take care of an aging population? And technology is probably going to solve all these problems if we don't get fat, dumb, and happy. All right. Anything else, Towelie?
No, you said it all, man.
Is that all, Towelie?
Oh, I got more, but I'll leave it for the campfire.
All right. Innovative industrial properties, I think, is better than all of the ETFs for cannabis. The only people who really shouldn't be investing in this are the halal investors because they can't. But whether you're a growth or income investor or a growth and income investor, I think this is probably the one to get it into. Don't fall into the trap of saying, well, I'm waiting for it to come back. Man, it's been there and back. Maybe you get a dip down here a little bit below 80, maybe. But I started to scale in today. So I would be looking for a starter position ASAP, then maybe selling the puts that somebody mentioned. The January 2024 puts for $85 are paying, looks, he says 700 a contract. So that must be $7. So pretty good deal there. So if you can sell the January 85s, get $7, that is, $78 net cost, which is pretty darn good. So I'd be taking a look at doing that. You'll need a big enough portfolio to do that. I do think take the starter position no matter what pretty quickly, because the next good news probably sends these up 20-30% again, just like the little rally that we've seen off the bottom. All right, have a good day.
Yeah, everybody, and have a great Labor Day weekend too.
Good afternoon.